Dan Rivers, Rivers Capital Group. I want to start off by saying tomorrow morning, 10 a.m. it starts, Market Pulse. You can hop on my social media, follow Kelly, log on to that Zoom. We're going to be talking about the market for 2024 with a couple of panel experts. I'll be on that with a few others. And then we're going to get into funding, insurance, taxes, legacy. Family's doing that with Tim Gratz, but it's going to be very valuable. So anybody wants to hop on that, I would suggest to do so, and it's free. I'm just promoting it because I think it's going to be a lot of value. So let's chat a little bit about the market. So for the end of this year, December versus December, our median sales price went from 390, which is basically the end of 2022 was about 390,000 to about 405,000. That's your median sales price. Days on market jumped up from November to December from 16 to 22, pretty common. We all know December, you got about 2 weeks and it slows down to almost a halt until about the second week of January where things really start to pick up again. That's pretty common. Mortgage applications usually increase drastically from second to third week of January to about mid-May. So we'll really be able to see over those 5 months kind of where we're looking at for the market this year. But I will make some notes that last year, I remember early on in the year, it was maybe February or March, we're tracking, it's like 800 homes sold, 900 homes sold. But I think we finally got to 1,000 in March of last year, if I remember right. So we're looking at, hey, are we even going to get to 12,000 homes sold last year? We got to just under 17,000 homes sold. It was like 16,931. The year before, I think these stats are actually pretty interesting. So 16,900, let's say, homes sold in 2023. 19,900 and change sold in 2022. 24,000 and change sold in 2021. And the last stat was 22,000 basically in 2020. But it kind of showed you, we all know that quick spike that happened during COVID kind of came back down in 2022 after the rates stayed pretty low until that early 2022. And we saw one of our lowest years in about 10 years as far as homes sold. Having said that, we all saw the Feds kind of froze. The bond market went down. It's 3.94 today, wow. 10-year Treasury. Okay. 3.94. And if people really followed that over the past 3-4 years pre-COVID, you're talking about what, 1.5 to 2 bips above 10-year Treasury is really where the interest rate would settle. So even if you kind of shrunk that delta at this point, you're talking 5.5 interest rates. But we're at 3.5 bips right now. That's why we're in the 6s and the 7 over the 10-year Treasury yield. I think what a lot of the people want to see is we'll see some stability once things just kind of settle in. One of the Feds screwed up, opened his mouth and said something stupid again the other day about, well, we're not sure if we're going to raise or not again. It's one of them, they're playing this game. They've already ruined the economy by going way overboard on interest rates. So we'll see how they settle in. But I think some of the biggest things to watch is unemployment, what this 10-year Treasury does, and just keep an eye on the market over the next, week to week, over the next few months. I'll continue to give updates. Anybody who wants to get on our email list, which is going to be a lot more detailed update, hit up Nicole@danrivers.com. You can get the really detailed market updates on there, but I just wanted to throw a couple of lease stats out, and as of, I think those are the main ones, as of tomorrow morning at 10 a.m. again, if you want to be on that, hop on my social media, you can log into that Zoom and get a more detailed market analysis of what we're looking for 2024. I think that's going to be super impactful. And again, Nicole@danrivers.com for the market update. I do want to call up for the short-term rental market update. Mike Savage, short-term rental genius and groups. He knows the inside and out. He's going to give you a quick update on how the short-term rental market is looking.
Thank you, Dan. So AirDNA, which is one of our primary data sources that we like to use with short-term rentals, they just dropped their a report covering basically what happened in 2023 and what they're projecting for 2024. If you're curious for the whole report, I posted it on Facebook, but I just wanted to highlight a little bit of that and more importantly talk about what that means for us. So 2023, traveler demand for short-term rentals, it slowed as a percentage, it decreased, but it still reached a record high. So I know there's a lot of talk about Airbnb bust and nobody's booking anymore. Like, demand was at an all-time high in 2023. The flip side of that is nights available grew by 12.8%. So, that delta, we did see a higher increase in supply than we did in demand. If we look at the past 2 years, in fact, demand grew by 23.8%, which is crazy. That's awesome, right? But supply grew by 36.7% over the last 2 years. So really, over the last 2 years, we're looking at that delta from 13%, where supply outpaced demand. So for those of us that struggled a little bit in 2023, that pretty much tells the story right there. That increased supply, along with consumers, that COVID relief money was drying up. The spending spree that everybody was on, 21 and 22. So we saw people's wallets were a little thinner, surplus of supply coming on the market, and that's why we saw decreased occupancy, decreased average daily rates, and most importantly, decreased RevPAR, which is, I'm not going to go into it too much, but kind of marries those together. It's really our most important KPI in short-term rentals. And in fact, that was the first annual decline in RevPAR since 2014 in short-term rentals.
What do you do different when it gets stale like that? Like a lot. Who has short-term rentals in here? Who has short-term rentals? Okay. Is everybody seeing what he saw got a little stale in 2023? Yeah. Yeah. So what did you do different, Mike, in 2023 to? I don't like those excuses of, it's the holidays, so it's going to be a little slow, or the market's got a little soft. What did Mike Savage do differently to make sure his pocketbook didn't get hit?
Yeah, I mean, my property and my revenue went down as well. Like, you can only do so much. But what I will say, my victory personally is I can look at the market and say, okay, I outpaced it by about 20% occupancy. Like I outpaced projected revenue for my units. Like when I calculate that and look at what price slab and Airbnb is telling me.
What about some other ideas within? Like I thought that was cool, and I don't know if it ever came to fruition, but we had a property in North Charleston, if I remember correctly, and you're going to buy a property next door. One had a pool, one didn't. They was going to put a walkway in between both properties so both units could use that pool. Or I don't know if it came to fruition, but stuff like that, I was thinking, great idea.
It didn't yet. But,
okay.
Yeah, I mean, we talked about that in December, right? Like, different is better than better. And that's so true, especially when you get into this excessive supply. And, everywhere's a little different, too. Like, I'm offering some national data, which I think is very relevant to here in Charleston. But even here in Charleston, right? Like, Mount Pleasant has about 400 short-term rentals. Park Circle, I'm going to share something a little later. Within 2 miles of Park Circle, there's about 567 listings. Like, holy shit, man. Like, 567 listings within 2 miles of the Park Circle. Yet in all of Mount Pleasant, because they have a cap, 400 listings. So my property in Mount Pleasant was affected much less than my properties in North Charleston. But getting ahead to 2024 projections, they're projecting demand growth of 10.7%. So actually, some improvement there, continued improvement. And supply growth, they do expect to slow to about 10.9%. So those numbers are almost identical, which shows us there's some stabilization finally coming, right? That's the good news. The bad news, in my opinion, is stabilization means 2024 is probably going to look a lot like 2023 in terms of the overall data, in terms of occupancy, in terms of revenue. They project occupancy to be pretty much identical, and revenue to maybe grow by about 2% RevPAR there. The good thing is it'll be stabilized, so at least now, 2023 didn't just suck because of the numbers. They were so all over the place and changed so much that we couldn't work off of 2022 right now. Now we have 2023 data, so we can use that data going into 2024 to just make much better pricing projections.
And where does somebody go to get that data?
There's a lot of sources out there. Like I said, AirDNA is pretty good. I use PriceLabs. AirDNA is a resource. I use PriceLabs to set my pricing.
Okay.
There's Wheelhouse. There's several others out there. It comes down to preference, I think. They're very similar. But it's very important that you understand that they can only do so much for you. You've got to understand the data and be able to gather the data too. So again, what does this mean for us? My personal hope is that 2024, might see some significant growth and get back to where we were. I don't think that's going to be the case, and this kind of supports it. I think 2024 is going to be more of the same. I think by 2025, we'll see more of a correction in the opposite direction, but I think we're just going to see stabilization in 2024. And so I think for a lot of people, like, who probably had a similar mindset, maybe they didn't have a good 2023, and we're kind of thinking, hey, let's see what 2024 does. I would really reevaluate that approach a little bit. I think, if you were happy enough with 2023, like not ecstatic, you're probably not getting any worse from what that was. But if you were losing money in short-term rentals or breaking even or just, not worth your time and energy, maybe it's a good time to look at, selling in the spring, pivoting to long-term or medium-term rentals, or evaluating your listing and saying, can this do much better? Can I improve the performance of my listing? So I'll leave it at that. But again, I wanted to kind of go from macro to micro and just provide a good example. I know we talk a lot about the saturation and all these listings, and that's true. It doesn't mean there aren't opportunities. I reference Park Circle because that's by far the most saturated market in this area, due to the lack of regulations that they had there. So there's 567 listings within 2 miles of Park Circle, right? Average revenue across those was about $33,000 per unit. But if we break that down, we take studios to 4 bedrooms. 560 of those 567 fit into that category. I said that those were the ones that were averaging $33,000 in revenue annually. There were 7 listings in that radius of Park Circle that are 5 or 6 bedrooms. I looked through those. A couple of them hadn't been in operation very long. Two of those had been operating for the entirety of 2023, and those grossed $96,000 and $116,000 in revenue, respectively. So when we talk about saturation, you need to be careful not just talk about a market, it's bedroom count, right?
Yeah, good idea.
Park Circle is definitely saturated with those conventional, 1 bedroom through 4 bedroom properties. But even in a market like that, we can see that those larger properties have a significant premium in terms of their earnings potential.
Yeah. Thank you, Mike. Appreciate you.